All right. So again, guys, welcome. My name is Ernest. We're going to do another video for you today. Hopefully you have a chance to watch the other videos that we just posted and you can continue learning with us with the MMC University. So today I'm going to be talking about the benefits of common stocks. Let's talk about that. Or I would say the benefit of just have some stocks. Okay, you know why the reason you should have some into your portfolio. But let me ask you this question: why investor buy common stock? Why would you put in common stock into a portfolio? Let's talk about this. All right. So the main reason really that you have to put people buying or investors they buy common stock is for growth. They want to see the money growing for capital gain, capital appreciation, capital hedge against inflation. Because inflation, when it goes up, they stock keep up with it. That's the reason they're looking for that growth, so they get that stock. So you need to know that's why they do that. That's one of the benefits. Another benefit, they purchase it for income, because people, when money, they want dividend income, so they get it because of income. That's why they get it. Also, they get it for both. Okay, maybe for growth and income at the same time. You find people get it, for capital gain, and also for dividends. So that's why people purchase common stock. They also get it for voting rights, because at the end of the day they can vote for the board of directors. Okay, they can vote for that. I know some of you probably you get some stock and you get that letter into the mail so that you can vote for so and so. I know what you say. Yes, that's exactly what I said. I don't know none of them. But because you have the right, they have to send you that information so you can vote. So that's a big deal of owning common stock. Also, limited liability. What do I mean by that? Is because when you invest into a company, you're buying the stock, because whatever you put in, that's all you can, pretty much lose. So if you put $200, you can only lose 200. Even though your $200 go to like maybe $500, but at the end of the day, you only put $200. So your loss is pretty much is limited. Make sure you know that as well. That's another benefit. And also, you need to know common stocks holders have the right to vote for the corporate board. I already mentioned that to you. So you have the right to vote, for the board of directors. Also, common stock is freely transferable. That's another beautiful thing about it, because you can transfer it to anybody, anyone that wants to buy. You can just put it for sale, and they can buy it, and they can receive it also as a gift. So you can take that stock and you can give it away. And that's another beautiful thing of owning common stock. Now, this is a notes here, okay? I want you to read the notes. Shareholders have the right to sell or give their share away without the corporation, or what we call the company, permission. So you don't need to let them know I'm going to give this my stock away. So because hey, listen, this is my money. I do I do whatever I want to do with it. I give it to whoever I want. Okay, I can sell it whenever I want because it's mine. Okay. Also, without this feature, we'll not have the stock market today, because if we didn't have that free way of trading, so we're not going to have the market, what we call it today, like where people can go make some money. Yeah, that we not have that. So that's the beautiful thing of it as well. But now I'm going to talk about something that's very important. Remember about I was telling you about also in some videos before, you can also vote. Okay, let's talk about how investors cast their vote. There's two ways they can do that. Okay, there's two ways they vote. So a shareholder can cast their vote, or maybe a vote, that's depending how they choose to do it. But there's two ways they can do that. When they're gonna select it, maybe the board of directors, maybe an item. And today they're gonna put for voting. So that's depend what it is. So it can be the vote of the board of directors. You can vote for that. Or maybe they're gonna change some rule and they want you to vote. That's depend what it is. And I'm gonna tell you how you can cast this vote. There's two ways to do this. Okay. One, this is what we call statutory or accumulating voting. Those are the two ways you can do it. But I'm gonna explain those two for you to see if you can, get your head, give you some also example so you can get a chance to learn that. And when you go into the exam, so you can know which one, is beneficial to who. All right. Let's talk about statutory voting. It's allow a shareholders to cast one vote in each item or candidate for the board of directors, whoever that in that ballot. Okay. So for example, if you have some votes, for example, okay, and let's say that I'm gonna give you two examples in a minute. Okay. So you might have like, let's say 100 shares. Okay. If you wanna do statutory voting, you and they put 3 people, so that's when you're gonna have 300 votes. So you can just decide it 100 for each, because that's called statutory. So that's been 1 vote gonna go for every candidate. So you can choose it to do it that way. Okay. So you're not gonna say, oh, let me just give this person 200, let me just give the person 50. No, statutory means you can cast 1 vote per item. Okay. Cumulative voting allow the shareholder to cast their vote however they want it. Okay. So they give you the privilege where you can cast it however you want. Because if you don't like Ernest, I was on the board, for example, okay, and you don't like me, you don't need to put the vote for me. Okay. If you like Jean, and put everything for Jean. If you like Peter, put everything for Peter. Or maybe if you like Claudia, just put everything for her. Okay. But if it was statutory voting, you can just put, pretty much the same amount for all 4 of us. All right. So let me just give you the example. So let's say like you have a shareholders that have 100 shares of ABC Corporation. All right. So now there's 3 board of directors they wanna, elect, 3 of them. All right. So if the shareholder chooses statutory voting, now they're gonna vote for the board of directors. Remember, there's 3 of them, so that's 100 shares. So that's mean if you take that, there's 1 seat. So 100, you can do 100 for the first seat, and the second person you do another 100, and the third seat you do another 100. So that's pretty much your 300 vote will be done. That's how you will do it. 100 for each seat. All right. But at some point, it may not be advantageous for more shareholders, okay? But now, if on the other side, if you choose, you can cast some cumulating voting. Now you can take, you know what? I don't like seat 1. I don't like this person, even though most of us don't know who they are. You might say, well, I don't like that person. Maybe I like the name of the second person, and I want to put all the 300 vote for them. Well, you can. That's how you choose to do it. You can. But also you can decide that since it's 3 of them, or if it is 4 of them, I might say, well, the first one, 50. The second one, I can do maybe 100. Maybe now I would cast 150. There's 150 left. Maybe I can decide it. The third one, I give them the whole 150. The last one, I give them 0 vote. See, the cumulative give you the benefit to cast it however you want it. But the statutory say, you know what, you're gonna cast it like exactly the same amount for every item into the ballot. So that's what you got to know. So when you go to the exam, so make sure you understand those 2 when you come to voting. All right. So now, why would you include common stock into a portfolio? Why would you do that? Well, again, remember when we were talking earlier, it's about, common stock, it's give you hedge against inflation. But then I give you why you should include that into a portfolio. Number 1, there's the potential for capital appreciation. So that's mean the money can have a chance to grow. The second reason you have to include that is for income. People that are looking for income, they want that dividend from that stock. So they want that. So therefore you can put that in there for them as well. I know some of you, I don't watch you watching right now, you say, ooh, the dividend is sound nice. The income is sound sexy. So therefore I need some stock too. But if you do, make sure you include some of those common stock into your portfolio. Another great reason is the hedge that I was talking about against inflation, because it helps you against inflation because it can keep up with inflation. Okay. But there's some other type of security. You don't have that protection, but common stock does, because it gives you the hedge against inflation. When we talk about the hedge against inflation, that's mean as inflation goes up, so you can still have a chance to make, your dividend can be a little bit more. All right. So common stock, in summary, let me just give you the summary of it. So all companies, they issue common stock. Why? Because, man, that's one of the great way to waste money. That's one of the great ways to waste capital. Okay, then I don't have to really promise or guarantee, I say benefit or profit. Okay, so all corporations issue common stock. Also, is also for the ownership, because you hold an ownership, the equity position that you hold into that company. Okay, you have to remember that as well. Also, one thing that I'll say, this is kind of like a downside to it. is most junior security. That's mean in case of liquidation, in case of bankruptcy, you will be the last one to get your money. Now, I know you're not gonna like that, but that's part of the game. Okay, it's just like risk and reward. So the more risk, the more reward. So at the end of the day, it's just like you lost. Okay, if you're going to test question, which one is last? It's common stock. Make sure you get that. Okay, has residual claim. That's what I was explaining to asset in if a company goes out of business or liquidates. That's mean if they file bankruptcy, you have the last chance to get your money. All right. So pretty much, I tell people that on common stock, you got the left. I didn't have to put it that way, but you got the leftover. Okay, it's just called the leftover. Okay, but sometimes the leftover can be very good too. Okay, because there's some benefit with it. But when that happens, nobody like that stuff. Let's hope the stock that we own don't go to that situation. Also, you have limited liabilities. That's another great things about common stock. So that's it. That's an advantage pretty much. It's the liability. It's limited based on the amount of you invested. So pretty much, you need to understand this. The notes said that shareholders have the right to sell or give their shares away without the corporation permission. And because you have to understand, when you own common stock, you can do whatever you want to do with it. You can give it away. You can sell it to whoever you want. You can do whatever you want to do with it. So why you should invest it? Remember the reason. You can put those things into a portfolio. It's a great benefit. There's some good, there's some bad. But at the end of the day, I think you can make things happen. Study for the test world, because when it comes to the real world, it's probably a bit different. But at the end of the day, you better make sure you understand those concepts I just share with you. And hopefully you can take them and learn them. Maybe you have to go back and rewind this tape again, and we watch that thing over until you got it. And that's the whole purpose of putting this video together for you. Hopefully I tap you out until we can come up with the next video. And listen, if there is a video that you want us to talk about, hey, maybe you might be really hungry for it, let us know into a comment, or maybe give us a thumbs up, or maybe share it with a friend and let us know so we can do that video for you. Really appreciate you guys. One love.